When companies raise capital, whether through Reg D, Reg CF, Reg A, or public offering, one of the most important disclosures they make is the use of proceeds. The SEC requires this disclosure because investors want to know one thing: how will the money actually be spent? Not how it might be spent, not how the founder hopes to spend it, but the specific categories where capital will flow. And here's why this matters. Capital allocation is the single strongest indicator of leadership discipline. You can tell everything about a company by how they allocate capital. Some companies turn $1 million into a profitable expansion. Others burn through it without increasing revenue, margin, or enterprise value. Today, we're going to break down what use of proceeds really means, the SEC's expectations, how different capital paths require different allocation strategies, the most common spending categories, how public companies disclose use of proceeds, why misuse of funds destroys valuations, and how disciplined capital allocation can accelerate growth and prepare you for institutional investment. Let's start with the basics. What does use of proceeds actually mean? In every offering, private or public, investors want clarity on how the company intends to use the money. The SEC requires companies to categorize proceeds into clear, auditable buckets. This isn't optional. It's a compliance requirement. Companies must disclose categories of spending, expected percentages, whether proceeds may be reallocated, any debt to be repaid, any compensation to executives, any transactions with related parties. This transparency protects investors from surprise spending, and it forces leadership teams to think strategically about capital before they raise it. In private offerings like Reg D, disclosures are more flexible, but still expected. Reg CF and Reg A have more formal requirements. You must outline use of funds clearly. You must show how your plan changes at different raise amounts. You must avoid vague or overly broad categories. The SEC may require clarification during review for Reg A offerings. In IPOs, the use of proceeds section is highly detailed. Underwriters want precision. Institutional investors want clarity, and the SEC reviews the section carefully. One thing is consistent across all offering types. Misrepresenting use of funds is considered fraud. If you tell investors you will use 40% of proceeds for expansion and instead spend most of it on management bonuses, that is a major violation. The rules are there to protect investors and to create accountability for leadership. Even beyond regulatory expectations, investors look at use of proceeds as a signal of leadership maturity. Ask yourself this question. When you see a company's use of proceeds, can you tell if they thought deeply about their growth strategy? Experienced investors can. They look for alignment between capital raised, the stage of business, planned growth initiatives, milestones, revenue expansion, operating leverage, risk mitigation. For example, a company raising $2 million that allocates 70% toward marketing and only 5% toward delivery and infrastructure signals operational risk. A company allocating 30% toward technology or automation signals scalability. A company allocating a portion of funds to working capital reserves signals financial discipline. Investors pay attention to these signals. Here are the primary categories most companies include. Technology and infrastructure. This is one of the highest return categories. It includes software systems, automation tools, internal dashboards, compliance platforms, customer-facing technology, and equipment upgrades. Infrastructure strengthens margins and improves capacity. Marketing and customer acquisition. Direct investments in revenue growth can be advertising, lead generation, sales teams, brand campaigns, or expansion into new regions. Investors want to see measurable ROI tied to marketing spend. Hiring and talent development. This includes leadership, operational staff, and specialized roles. Companies must disclose if founders receive salary adjustments from proceeds. Strong teams are essential for scaling. Investors understand this. Operations and delivery. funds used to improve fulfillment, equipment, supplies, inventory, or production systems. Operational improvements reduce customer churn and improve margins. Working capital. This category supports day-to-day operations, cash buffer, accounts payables, inventory cycles, insurance, rent. Working capital is the lifeblood of a scaling business. Debt repayment. If used, companies must disclose the lenders, disclose the interest rates, explain related party relationships. Investors want transparency around any debt being satisfied with offering proceeds. Contingency reserves. Good capital planners allocate 5 to 10% to contingencies. Unexpected costs always arise. In public filings, especially S-1 filings for IPOs, companies often break down use of proceeds into extremely granular detail. For example, a tech company might disclose 35% to product development, 25% to sales and marketing, 20% to working capital, 10% to general corporate purposes, 10% to pay down specific debt obligations. These disclosures provide institutional investors with confidence that the company has a strategic plan for deploying capital. If the company later deviates materially from this plan, they must disclose it in quarterly filings. This level of transparency creates trust. When companies misallocate capital, several negative outcomes occur. Margins decline rather than improve. Growth slows instead of accelerating. Burn rates spike. Leadership credibility collapses. Future funding becomes difficult or impossible. Valuation multiples contract. Misallocation is one of the top reasons companies fail after a raise. Raising capital amplifies leadership judgment. If your decision-making is disciplined, capital accelerates success. If your decision-making is careless, capital accelerates failure. The most dangerous use of proceeds category, general corporate purposes. This category is acceptable in moderation, but the SEC scrutinizes it heavily because it is non-specific. If a company relies too heavily on general purposes, investors fear lack of planning. Sophisticated leadership teams keep this category small and supplement it with precise allocations. Investors prefer companies that use capital to create operating leverage, increase enterprise value, and reduce risk. Here's a simple but powerful framework. Number 1, stabilize. Invest in systems, infrastructure, and team capacity. Number 2, optimize. Improve margins, reduce inefficiencies, increase clarity. Number 3, expand. Deploy capital into scalable, revenue-generating activities. Number 4, protect. Establish reserves and risk mitigation mechanisms. This model applies across industries, from manufacturing to healthcare to professional services. The key takeaway: use of proceeds is not a formality. It is a blueprint that reveals leadership maturity, strategic clarity, and operational readiness. Investors don't just fund ideas, they fund disciplined execution. How you plan to spend capital is more important than how much you raise.